Hello there and welcome to Vienna to the OPEC headquarters. This is the edition of Oil Market Insight coming to you on the occasion of the 169th OPEC conference. And we're coming to you here from the press room at the OPEC headquarters. Here, of course, the venue where many of you will be familiar with listening to the OPEC decision always after the OPEC meeting where the press conference is held right here. So here, the very, very hub of OPEC, we're here to look at Oil Market Insight and my panel of experts here to help us. Let me quickly introduce you to them and we'll get right down to it. Jason Schenker joins us from the US. Jason, of course, is the president of Prestige Economics from Texas. We're also thrilled to be joined by Gaurav Sharma. He is the business editor and an analyst with IB Times. Thank you so much, Gaurav, for coming to join us. And from Austria, from Vienna here, David Wech. Thank you so much for joining us, the Managing Director of JBC Energy. Now, David, I'd like to start with you. And when we look at the strength that has come back into the market and come back into the oil price over the last 6 months, the first half of the year pretty much behind us now. When we look back, what has been the momentum that has actually been driving that?
On the one hand, there's of course very strong demand growth. We had about 1.7 million barrels per day last year. We expect this year 1.3 million barrels per day after regular upward revisions in the recent past. On the other hand, on the supply side, we see the first impact of lower prices with US shale oil being in decline. There have been a number of outages recently, so basically the market is getting towards balance and this is getting quite some attention in the market. And looking forward, there is of course a concern that there will not be enough investment in future supply.
And all of those matters we're certainly going to touch on. Gaurav, though, when we look at the fundamentals of the market, absolutely important too, but also the sentiment of the market is beginning to change. What do you think?
Well, the kind of feelers that you get from the wider market is that most players expect a fair bit of rebalancing, not just next year, but for the next 3 years. So taking that into context, it will determine the direction of the market. I concur with my colleague that shale is seeing a fair bit of depression. We're seeing about 70-odd bankruptcies stateside this year alone. So there will be a production correction, and that will weigh on the wider market sentiment.
Now, Jason, I know I always have you as the spokesperson for the US when it comes to what's going on the market there. But you're watching, obviously, the world, but watching the US market very, very carefully. A lot of oil has come off the market. A lot of production has come off. Bring us up to date with what's going on in the US.
Well, you know, we've seen about 425 to 450,000 barrels per day come off in the US just since the beginning of the year. So that's a big drop. And as we look forward, even if prices remain where we are now or a little higher, around $50 a barrel is still a price point at which you're going to see continued bankruptcies, you're going to see layoffs, defaults, all kinds of problems in US shale. So you're going to continue to see those problems even if we remain at this price point. And to concur with what Gaurav and David have said, as you look out 2 or 3 years, I think there's a lot of upside for prices because you have the potential for reduced capex in the short term to limit prices as global demand continues to rise.
But when we look at oil demand also, Jason, we're seeing that the oil demand growth, the additional demand growth, that has actually come off quite a bit really in the past 2 years. I think maybe about 2 million barrels really.
Well, the oil demand growth this year we think should be solid. I have a slightly higher estimate than what David's saying. I think we'll see 1.5 million barrels per day extra. But, you know, I think you're going to see low prices cure low prices here. And that should be solid. I know we're seeing in the U.S. very strong demand. We've had record miles driven. They do a 12-month moving total basis on what that since December 2014. We've seen records month after month after month. Summer driving season this year is going to be really strong. And OECD demand had been something that's been in decline since 2005. But, you know, this pop in demand is really being engendered by those low prices. And that's going to help bring the market, I think, back into balance.
Now, the strength that we've seen come back into the market, David, and we've seen that price come up there around 50. Many of the shale operators in the U.S., you know, when we look at them maybe coming back into the market, they're certainly looking at prices. But we've seen a bit of resilience in some of them. What price level do you think that people would want to come back or take the risk about coming back?
Yeah, one has to differentiate it. There is simply no single price level. We would argue that some shale plays look fine at even $30. Yeah, others look fine at $40. Others will probably need perhaps $60 to $70 to come back. So there is no straightforward answer. What can be said is that so far the decline has generally been less than what has been expected, including the American Energy Administration. So new technology better employed technology, falling costs all across the board are helping basically to bring these prices down also to some extent.
What do you think, Jason?
Well, I think that I would agree with David's point about there's different price points at which you're pulling the oil out of the ground. And this is, I think, where we need to differentiate between operating expenses and CapEx, capital expenses. And on the OPEC side, there's a very big difference between what it costs to pull the oil out of the ground, and a lot of the shale plays are in the money at this level. But the problem is on the OPEC side, on the CapEx side, where are you going to be able to make additional new investments? And back in November, on November 5th of 2015, the Fed, the FDIC, and the Office of the Comptroller of the Currency, three critical regulators in the banking side, issued a strong warning about risk to the economy because of leveraged lending in oil and gas. And this warning was really important because it sent a message to the banks to be very, very careful about issuing additional debt in this space, which means if you're going to get more drilling, the CapEx has to come from somewhere, and it's going to likely be shut out on the banking side for some time. It means it has to come from other sources of investment. So while OPEX-wise companies might be doing better, CapEx-wise they still might not have the money to drill those wells, and we're looking at a lot of operators that could potentially lose pay-zone leases, the ability to drill in some of the places where you've got good rocks. You might even lose those because they can't get the money to drill those wells, not even at $50.
And you recently got back from the US, Gaurav. I mean, what did you find?
Well, the feedback that we have from the law firms, and you need a lawyer to sign off on the documentation for a drilling permit, is that drilling stateside has completely ground to a halt. You know, that's what we're noticing, and right now the focus of a lot of smaller independent stateside is to just get their house in order, get their finances in order. Not all of them might be able to achieve that, and of course, to agree with David, there's no single price point. There are some folks who are comfortable with $30, $35, but a number of the fringe players, they're in a whole lot of trouble.
Now, we're seeing some strength in the market. We're seeing some demand strength. We've always, in the last few years, demand strength has been there. Obviously, there's been some oversupply. But when we look towards, you know, the medium term, and we look at the demand, and we look at the growth that may have slowed down in China and the Asia-Pacific too, but there's still growth in the demand, isn't there, David?
Yes, I mean, oil demand generally has two strong pillars of support. The one is private transportation, whether that is in cars or by plane, and the other one is the petrochemical industry. And these two pillars of support, we don't see how they would go away quickly. Yeah, so at least until 2020, we see quite some support. Post 2020, in the private driving side, it will be interesting to see how much electric cars can come into the market. But gasoline will most likely remain a very important source as a fuel going forward. And from that point of view, there is still a good future for oil, but the industry will slowly but surely transform at one point of time from a growing one into a stagnating and ultimately declining one. And the big question is whether in such an environment you will be able to attract sufficient investments.
Again, the investment side, very important. But stay with us here on China at the moment and the growth that we are seeing there. Obviously, it has tempered quite a bit in the last few years. It's steadied, but there is still growth there. And we look at the strategic reserves as well. China has been topping that up.
Well, that's while they have been adding to their strategic reserves, and their oil demand growth is likely to continue. That's because of an emerging middle class, and that is, to get to what David's talking about, that's an aircraft carrier that's turning. You're not going to stop that trend. The manufacturing side in China has been very weak. The data through May reflect a manufacturing recession in 17 of the last 18 months. You've seen month-over-month contractions for a year and a half. But even though that's been going on, the oil demand growth and that emerging in the middle class is still going on, because manufacturing is 31% of the economy and the other 69% is on the consumption side. And that rising middle class is going to continue to demand more crude. It's going to continue to demand more cars. What that does to the overall Chinese economy is up for debate, and there are downside risks for the Chinese economy as a whole. But this long-term trend of continued fuel consumption by individual consumers, as you have this massive emerging middle class, that's not likely to change anytime soon.
Gaurav, where else, when we look at demand, where are we looking? OECD meeting in Paris this week as well, and they're saying what, that it's, you know, OECD stagnated. I mean, we pretty much know that when we look at growth at around 3% is what we're hearing there. But when we look to demand hubs, so to speak, and the potential for demand, where do you see it coming from?
You know, from a supply side analyst standpoint, if you look at all these guys sitting in front of their solver models, who's procuring what, where, I think to add to what Jason has already said, I think India is another big hope. They're building strategic petroleum reserves of their own. Of course, the data is not in public domain, but you can pretty much work out what they're looking at from the shipping dispatches. So India is another big hope, and if you look at the big five, Japan, South Korea, India, US and China, right after China, I would say India is a great big hope for the market. Sadly enough, the Japanese intake is not as great. In fact, it's in decline. But I would say India would more than make up for that.
And again, the monetary issues in Japan, they're looking closely at that at the moment. It'll be interesting to see. And we'll come on to the monetary issues and the Fed, be it Japan or be it the US as well. How's that going to impact?
Well, I think that obviously what's going on with monetary policy, we're at an inflection point. Before we go to that, I would just say one thing about what Gaurav just mentioned, and that if you look, OPEC publishes their expectations for forecasts for the next 25 years for where oil demand is coming from, and over 70% OPEC is forecasting is coming from India, China, and other Asia. So this is where this is all coming from. And monetary policy in Japan, I think, is going to be maybe less critical for the oil market, and I think that's even true with the ECB, which I think is eventually going to wind down its quantitative easing. You've seen improvements in manufacturing in Europe, and although people often talk, and I hear it in the States, they're very quick to say that manufacturing growth in Europe is quite slow, but for 9 of the past 10 months through April, European manufacturing improved month over month at a quicker pace than U.S. manufacturing, or it improved while U.S. manufacturing actually was contracting. So things in Europe are getting better. In the U.S., you have a risk of a Fed rate hike. I think they're going to wait for July. The June Brexit risk, which I don't think there will be a Brexit, but the risk to the entire financial market is something that would make the Fed wait. The point is the Fed is in a tightening mode, and the other central banks are still in a highly accommodative mode. This is something that could make the dollar strengthen and cause a bit of some choppy trading and pricing for oil and other commodities through the mid-year, but it's also something that's going to engender some slowing of growth later this year and next year in the U.S.
I mean, ultimately, David, the state of the global economy and any of the components within that in any continent is so important for this industry, isn't it? I mean, it's what they're looking at constantly, looking at the horizon to make sure that there will be growth in the economy. How confident are you in terms of growth, economic growth, globally in the next year or two?
Yeah, difficult to tell. I'm not too pessimistic. I think most important things have been said here. I have always my little doubts when people are very pessimistic about China just when looking at oil demand figures. Yeah, they are rising so strongly in terms of gasoline consumption, in terms of petchem feedstock consumption. I think the Chinese economy is simply, as anyway indicated, in a transition phase, pretty far probably in that transition phase from an industrial export-oriented economy to a domestic consumption economy, and that looks healthy. India looks healthy. Russia is doing better than expected. Brazil is not particularly good, but at some point of time will also turn around. So, yeah, I think at some point of time we have to face again probably a downswing. Yeah, and we might actually at the moment be in a better state than what people were thinking. Particularly if I think back at the beginning of the year, the mood was so negative in the market, and I was always wondering where is that coming from? Because if you look at the figures on the oil market side, they are pretty healthy. So at some point of time we will move back towards a recession mode, but perhaps not yet next year.
And again, that's what everybody is really looking at, just keeping some strength in the market and keeping that demand. Looking at the US in terms of the demand figures that are there and looking at the growth. And again, it's not all spread out even. And when we look at the manufacturing numbers, various numbers coming out of there, it's not an even picture coming from the US either, is it?
No, it's not. There are pockets of recession, and there is in U.S. oil and gas. To give you some idea, and this is something that actually poses upside risk for oil prices. In Texas, for example, in December 2014, there are about 320,000 people employed in oil and gas. And the most recent month's numbers from March show there were 230,000 jobs in oil and gas. You lost 90,000 jobs, almost a third of the jobs in the oil and gas space. It puts you back to job levels at 2011 levels. Essentially, any jobs created in the shale period are gone. Manufacturing has been quite weak. Industrial production year over year, that's very weak. There are also some concerns about, I think, auto sales, because retail ex-autos is at recessionary levels. But if you look at auto sales, they've been very strong, but that's because of subprime auto loans. So there are some mixed things. Rail car loads are weak. Trucking's been weak. Anything industrial's been weak. But in manufacturing is only 13% of U.S. GDP. It's a very small number, especially compared to where China, it's 31%. 3%, but these are providing headwinds, and I still think that this is, a general concern for the global economy. Last month, over a month ago now, in April, the IMF released their growth forecast. In the press conference, they were asked if the global economy was in a crisis. One of the heads of research said, "We're not technically in a crisis, we're on alert for a crisis." Not very inspiring statements, but again, to David's point, if we look at oil demand growth has been good, and the biggest driver there is low prices cure low prices. And so you're still seeing solid growth there, while things look less good for copper or for ferrous scrap or for other industrial metals or for general global economic growth, which this year global economic growth could be below 3%, which is consistent with a recession level, even though it's still 3%. But for the global economy, not a great year. Oil demand growth could be very good.
When we look at the state of investment, and we take into account too the state of the employment market and all of that too, the investment that's come off the market, many of the analysts saying 1.5 trillion in the last 2 years. Gaurav, I'd like you to look at this. That's a lot of money off the market, and it's a lot of money that probably will not come in. Where's the big danger now that that money is off the market, investment has really been taken off, projects cancelled, delayed? When we look maybe a year or two down the road, I mean, could that indicate another price spike? What's the big danger of this money gone off, and the fact that maybe investment doesn't come back? I'll have you all address this, but Gaurav, please.
It's a little bit tricky. Now, if you look at this figure of 1.5 trillion, we subscribe to that figure too. So between June 2014 and to date, that's the it represents a 40% countdown. So if you take it on an even keel, most of the non-OPEC production has borne the brunt of it. Now, I'd not say I'm doing shale bashing, but there's a fair bit of malaise in the wider market. Now, let's switch tack. Let's switch tack closer to England, where I'm based. And if you look at the North Sea, 1 in 7 barrels is getting produced below cost. So there's lower investment. Now, another figure out in the market is that about $30 billion worth of decommissioning would be required in the North Sea over the next 10 years. Now, when the figure of decommissioning exceeds the figure of investment, then you know the jurisdiction is in trouble.
Jason, that issue on investment.
Yeah, I see upside. We look out a couple of years or so. I mean, I think growth in the U.S. and globally could be spotty over the next year and a half. But if we look out into 2018 and beyond, there's a lot of upside risk. I mean, the number of discoveries in the last year was the lowest it's been in 50 years for oil. Number of new discoveries. This is the level of investment is going to remain very weak. And I think in the U.S., again, you have the financial services regulators, the Fed, the FDIC, and the OCC, that issued very strong warnings to banks about whether they should be investing in the space. That warning was issued on November 5th of 2015 when the closing price of WTI was $45.20. Right? In the first quarter, it was the average price was 30% below that, and we're just now a few dollars above that. So we're just now back to a level that made the regulators very nervous about the banking system, which means the banks are going to be loath to put a lot of money into the space on a debt basis, which means you're going to look at money coming into the space from private investors, private equity. They're going to want very high rates of return, which means you might need to see the price go a bit higher before you see a lot of money come in as an influx of capex, which again delays that additional marginal supply you need after the market comes into a balance.
Now, many of the OPEC countries have stayed with their projects and continue to roll them out. But again, that lack of investment when we look at the wider picture. David, how dangerous is that when we look to maybe a year or two down the road and a possibility of another price spike?
Yeah, I would tend to see the little bit longer term issue. I would just like to say a few words. I agree, but basically that a majority of people looking at the oil market will say there is a clear risk that there is too little investment. On the other hand, I would like to point out that resource availability, in my point of view, is definitely not an issue, even there are not that much new finds, but there is a lot in the ground we know of.
When we look at the market at the moment in terms of the investment, I mean, okay, there's a lot off the market. Maybe some people are reviewing that and maybe putting more money on. Some of the OPEC countries still staying with some of their investments. But again, they're cutting costs and they're looking towards efficiency right across the board here. But again, the longer term risk taking that money out of the market.
Yeah. The point is that it's not that easy to invest for companies because there are so many uncertainties. Yeah? If you look a little bit more into detail, you may also come to the conclusion that there is still enough oil in the ground and in the pipeline. So it's not a straightforward thing, even though it's an evident idea that a lack of investment now will cause a spike. Yeah? So the point is simply that even though the environment might generally look supportive for investing, people might not go ahead. Yeah? Also because the price tags for investments in the oil industry are huge, yeah? And this is also where the shale is coming in, because in the shale field they are much lower, the price tags, so that might even take away further initiatives to drill deep water or go Arctic and so on. And the question is, and I can't fully give you an answer on that, is whether we will need these resources. Yeah? But people will be very cautious to invest, and so of course we can come into a situation where the market is tight. There are long cycles between the investment decision and the actual oil being brought on stream. For the big projects, something like 10 years, even for shale, probably something like a year and more. So the point there is, if pretty much all producers around the world are currently producing flat out, we might not have any cushion to shelter against strong upside in prices.
And again, looking at that too, the spare capacity is something that you're quite concerned about out there, really, aren't you?
Of course, yeah. I think there is, as we had in a long history, there is simply, there would be a huge benefit in an organization like OPEC holding such spare capacity, because it would protect the market against the upside. It's not only a question about the physical availability of oil, it's simply already the knowledge about such capacity being available will keep speculators in the market, traders, a little bit in check, yeah? Because without such a cushion, you can basically, it's very difficult to find the limit on the upside for oil prices.
Now, we do have to start wrapping this up. Gaurav, when you look at, again, the spare capacity issue, the investment issue, I mean, there's a lot that still can be done out there, but again, there is that volatility and there's the uncertainty in the market. That seems to be, in a way, what's holding people back.
Well, in these volatile climes, I think we should return back to the subject of investment, because we keep constantly talking about efficiencies in the business, and in some cases there are plenty of case studies out there where certain drillers have reduced costs from something like $25 million right down to $3 to $4 million, and that kind of efficiency should be appreciated. But you would see that a lot of people feeling pressure from that would probably be the oilfield services guys, who have to give more competitive contracts, who have to do things as per the parameters set by the driller. So investment is a very interesting subject, and it's going to evolve as the market progresses.
Indeed, everybody feeling the pinch. I'm going to leave you with the last word on this, Jason. You know, a lot of challenges out there, of course, but as we look ahead towards the second half of the year, where are the bright spots?
Well, you know, I think the bright spots are, you're still going to see Europe manufacturing here likely to continue to improve, growth continuing to improve, remains solid, job gains improving. So I think Europe gets a little bit better. I think that's a bright spot. I think for oil demand growth, the emerging markets, China, India, those are going to remain solid. Global demand, U.S. demand should be solid because of the low prices. Summer driving season should be really strong. I think those things are good moving forward. I think as we look further out, to get to something that Gaurav just mentioned, as we think about drilling, and to tie into what David said as well, you know, the additional oil could be drilled, but if the people leave the space, you know, if I think about just what's happened in Texas, where a third of the workers are now gone, if you need to bring them back relatively quickly, what are you going to do? So that could be a challenge moving forward, and that could put costs back in to the system. So I think that there's going to be a circular feedback loop there, and I think also future expectations feed through to the present, right? You also have, because of the forward curve, the ability for future expectations to be priced into the present. So I think that we do see some upsides for the underlying, for the price of oil, but I think for global growth, I think things are a little bit more touch and go for the next year and a half, and the same for the U.S.
Well, we have to leave it there. So, gentlemen, thank you so much for joining us. Jason Schenker, Gaurav Sharma, and David Weck. Thank you all so much. And again, that was it, this edition for Oil Market Insight. Thanks so much for being with us for this. And as you can see there, it's a volatile time, very uncertain time as we start the second half of the year 2016. So here on the occasion of the 169th OPEC conference, we're going to leave you from Vienna. Thank you so much for being with us, and stay with OPEC.org for more information. Thank you.